The next two lectures are to get you thinking about what investment fees are really doing to your long-term results. We created them so that you can see what you're really paying for and to show you some statistics on managed funds and why you might want to rethink where you're allocating your money. At least we want you to assess if your funds or money managers that you're involved with are worth the true cost. In these lectures, we'll arm you with some knowledge and facts on management fees and managed funds that we hope will make you better equipped to make some future financial decisions. And I think it will put you ahead of most of your friends and family and even ahead of many financial professionals. You have cable bills, internet bills, electricity, utility bills. If I asked you right now how much you pay each month for your basic monthly bills, most of you probably would have a good idea. If I asked you what you paid on your investment management fees last month or even last year, you might be left scratching your head. The reason is because you see your basic monthly bills. In some cases, you physically write a check, or at the very least, see it on your bank statement in AutoPay. Fees for financial advisors or money managers, well, those are different. You as an investor and future retiree rarely pay a bill for these services. They're deducted straight from your assets automatically or charged off the top of your account without seeing it in most cases. Because you don't see these actual bills, it's easy for investors to ignore the fees altogether. After all, they're small and insignificant anyway, right? Well, that's what many financial professionals will have you believe. But what is the real effect and the real truth of the fees that money managers or other funds charge in your retirement accounts? According to the Motley Fool, the average annual fee for an actively managed fund is 1.6% of the total account balance. According to Vanguard Mutual Fund's founder and longtime CEO John Bogle, the average fee is actually about 2%. Vanguard's one of the industry leaders in managed funds. The management fee you pay on your accounts might be higher or lower depending on several factors, such as the type of accounts you have, the total amount invested, and the actual holdings within your account. Now, most financial people will say that 1 to 3% is such a small amount, you won't even notice it. Don't worry about it, they say. And you really don't notice it in most cases. As I said before, you don't physically pay the fees, and you aren't shown a comparison of what your account would look like without those fees. It's just a part of doing business, and most just pay it because they don't think there's any other way. And truly, I've seen that most people really do believe that 1 or 3% is such an insignificant portion of their money. But that's far from the truth. And if only you were shown a comparison of what your account would be without these seemingly insignificant fees, that might start to get your attention. Let's take a look at what these fees you're likely being charged are really doing. When stated as a percentage of your total assets, average fees can seem innocent enough. The financial services industry certainly wants you to interpret your 2%, or whatever the total amount is for you, as being insignificant. In fact, they spend more than $5 billion each year in advertising in order to get this point across. They want to protect the assets under management, known as AUM, which they currently have, and of course they want to continue to bring in more funds. More funds means more assets under management and more money for them. But let's put things in perspective. Investors already own their assets, so these investment management fees should really be based on what investors are getting in return for the results the fund managers produce. It shouldn't be based on what you already have. However, they're actually receiving this management fee on all of your assets they have under their watch. This is whether they make you more money or lose what you give them. They get paid either way. In other words, if you have a $500,000 account and you're paying 2% in fees, then you're paying $10,000 every single year for the privilege of investing with a certain money manager or fund. And you're paying this if your account goes up, and in most cases, even if it drops by 40% or more, like most did in 2008. And the bad news is, if your account is lucky enough to rise this year, your fee in absolute dollar terms will rise right along with it. A $500,000 account at 2% might equal $10,000 in fees, but a $600,000 account in a few years at the same 2% equals $12,000 in fees. This really isn't fair to you as an investor, and further goes to show why they only care about AUM and not the net return they're getting for you. Let's take a look at what fees are really costing you in terms of the rate of return that you're getting, the accurate way. In other words, if I receive an X% rate of return, how much is that X% fee really costing me? If you're paying 1% in management fees and you're getting a 9% rate of return before fees, then that fund manager is taking 11.1% away from your returns. And if you're getting a 7% rate of return before management fees, then that fund manager is taking 14.3% away from your returns. And if you're paying a 1.5% management fee, then that same 7% rate of return before fees means the fund manager is taking 21.4% away from your returns. And at 2%, it gets even worse. If you're getting a 7% rate of return, again, before fees, then at 2%, at a 2% management fee, the fund manager is taking 28.6% away from your returns. This is a big deal, and calculated correctly as a percentage of returns like this, you can see that fees no longer look low, and they're certainly not insignificant. It's a business model that works great for the AUM business, but not for you as an investor and someone who's trying to find the best ways to ensure their retirement. In your preparation, you need every bit of forward progress possible, every advantage that's available to you. These fees methodically slow down your progression over time. Let's do the math. If your returns average 8% a year in a fund that charges a fee of 2%, then that means you're paying 25% of your gains every single year to fund managers. Over 30 years, take a look at what that difference is just in those 2% of fees to your overall account. At 8% with no fees, you'd be left with over $100,000. But subtracting those management fees out, you'd be left with just $57,000. That's a 75% increase in ending account balance just by avoiding fees. That's right, just by paying that 2% each year. Well, it's so small, right? You don't even notice it? Well, just by paying that 2% management fee in 30 years, every $10,000 you have will be worth $57,000 when it could have been worth over $100,000. That 75% difference in your retirement account balance went to the money managers that said you'd barely notice it. Starting to see the significance? Let's look at another example using the Motley Fool's 1.6% average fee. Let's say that you invest $100,000 with a financial advisor who is charging you 1.6% of your total assets each year to manage them for you. Keep in mind as your account hopefully grows in value, that fee in total dollars will rise as well. So it might be $1,600 this year on a $100,000 account, but it will be $16,000 each year on your $1 million account as time goes on. Well, in 30 years, without fees, your account could be worth over $1 million. But with those fees, your account would be worth just $643,000. Still a great amount, but nowhere near what it could have been. This is a 56% increase in what you would have available absent of fees. And that's if the fee is just 1.6%. Look at the drain on your account as the years stack up. These charts just really show the power of compounding, like we've talked about before. The 8% return on the left and 6.4% return on the right. The difference in interest just on that small management fee is huge. And even you can see by year 11, $17,000 interest earned on the left and $11,900 interest earned on the right. That's about a 50% difference just by then. And remember, we're talking a 50% difference on a 1.6% management fee. And then look all the way at year 30, you're earning almost double the amount in interest just by not paying that small management fee. So it is a big deal. And of course, looking at the ending balances, you can see as the years go on what a difference that really makes. And I hope these charts really help you visualize what that impact really is. So this is hardly insignificant, and that's really the point that we're trying to get across here. So just one more thing to really get these fees in focus for you. Imagine you received a bill and had to physically pay a $1,000 management fee on your retirement accounts each month, just as you would your phone or utility bill. Would you put up with this? Ignore it and say it's just a tiny little 2% fee? Probably not. You would at the very least look for lesser alternatives, I would think, that could get you similar, if not identical results. You'd call them up like you would a cable company and say, "What can I do to get this lowered?" But these fees, they're not presented like that for this reason. Because most people don't see that number that they're paying, they block it out of their thoughts. They hear 1% on this account or 2% over here, and it seems small, no big deal. But if you physically saw and paid it month after month, an increasing amount with hopefully increasing account value, it would start to hit home. If you realized the compounding effects of these seemingly innocent fees after all those years, you'd probably be outraged. You would have no tolerance for a high fee fund or advisor that didn't exemplify superior returns. Until you add these fees up for yourself and see what the effect really is, you'll remain unmotivated to seek alternatives. But by being here, you know what that effect can be. Just look at that chart that we just showed you. I hope we've motivated you to seek alternatives. Okay, so you get it. Fees hurt your account. That's no longer a secret. You've seen the math, the real numbers, the real drain that these seemingly small and innocent fees have on your account that leaves you climbing up the retirement hill with enormous weight shackled to each leg. But where do you go next? Well, first off, do everything you can to stop paying high fees. If any of you are paying anything over 2% in fees, just get out of there and find alternatives. Whatever fund or money manager is charging you more is just not serving you well by exhausting that significant of a portion of your retirement funds. Other options, you can start by investing in extremely low-fee index funds, which we'll get a little more into detail in the next lecture. After all, that's the advice from the greatest stock investor of all time, Warren Buffett. He suggests investors should be in low-cost, exchange-traded funds rather than in high-fee mutual funds. And he's a pretty good guy to listen to. As for other options, this is where you can talk with your financial advisor. Tell them what you want and what you don't want. The key here is you want investments with the upside of the stock and other world markets without the extremely high fees of mutual funds or various money managers. Let an advisor use their expertise by finding you these investments that match your criteria. Just don't get tricked into anything with extravagant fees. And most certainly, don't go by believing these fees don't really matter. You know better now.